A couple years ago, I remember opening my portfolio during one of those ugly market mornings where everything was just red. Tech stocks down, crypto collapsing, every finance account on social media suddenly acting like the economy was ending. And even though nothing about my long-term plan had actually changed, I still felt this weird urge to do something. Sell, move cash, protect myself before things got worse. And that feeling right there, that's where a lot of people quietly destroy their future wealth. Not because they picked terrible investments, not because they weren't smart enough, but because their behavior slowly overrides their strategy. What's scary is that the biggest money mistakes usually don't feel dangerous in the moment. They feel reasonable, temporary, even responsible. A study once showed that average investors dramatically underperform the market over time, not because the market failed, but because they kept reacting emotionally at the worst possible moments. And the problem with emotional investing is the damage compounds silently. One bad decision rarely ruins you, but small fear-based moves repeated for years, that can quietly cost someone hundreds of thousands, even over $1 million. And honestly, this mistake matters way more than finding the perfect stock ever will. I am Humphrey Yang. One thing I've noticed after years of watching markets, studying investing behavior, and talking to everyday investors is that financial success usually has a lot less to do with intelligence than people think. Some of the smartest people I know still make terrible investing decisions when emotions get involved. Because the market has this weird ability to change human behavior, when prices are going up fast, people suddenly feel invincible. Risk feels smaller. Everyone starts convincing themselves that this time is different. Then the second things reverse, fear takes over just as quickly. People panic sell, stop investing, move to cash at the worst possible time, or spend months waiting for the perfect moment to get back in. We saw it during the meme stock era. We saw it with crypto hype cycles. We saw it during recession fears, inflation spikes, and every major market crash before that. And honestly, emotional investing affects almost everyone at some point. Even experienced investors are not immune to it. That's why investing psychology matters way more than most people realize. People spend so much time trying to maximize returns that they completely ignore the importance of protecting their own behavior. Because in investing, compounding works both ways. Consistent discipline compounds wealth slowly over decades, but repeated emotional mistakes compound damage too. And usually, the damage doesn't happen in one giant catastrophic moment. It happens quietly through small decisions that feel harmless at the time. And if we're being realistic, most people have experienced some version of this cycle before. You open your investing app way too many times a day. You tell yourself you're just checking, but deep down you're looking for reassurance. When the market is up, you feel smart, confident, like maybe you're finally getting ahead financially. Then the market drops 5%, 10%, 20%, and suddenly your entire mood changes with it. You start consuming more financial news, more videos, more opinions. One person says we're heading into a recession. Another says it's the buying opportunity of a lifetime. Social media makes it even worse because now everybody online looks like they're making money except you. So you start questioning your own plan. Maybe you sell because you're afraid of losing more. Maybe you hold cash waiting for the all clear signal that never really comes. Then eventually, the market rebounds without you, prices recover faster than expected, and now a different emotion kicks in: regret. That regret turns into FOMO. So people jump back in emotionally after prices already moved higher. Then volatility hits again, fear returns, and the cycle repeats. What makes this dangerous is that none of these decisions feel irrational in the moment. They feel emotionally justified. Human beings are naturally wired to avoid pain and seek certainty, especially when money is involved. But investing rewards almost the opposite behavior. And over years, constantly reacting emotionally to short-term market movements can quietly destroy an enormous amount of long-term wealth. Not because someone lacked potential, but because fear, comparison, and uncertainty slowly kept interrupting the power of compounding. So here's the silent million-dollar mistake most investors never fully realize until it's too late. They interrupt compounding. Not because they're lazy, not because they don't care about money. Usually it happens because they're trying to feel safe. That's the part that makes this mistake so dangerous. During market crashes, panic selling feels responsible. Holding huge amounts of cash feels cautious. Stepping away from investing entirely can even feel intelligent when headlines are screaming about recessions, layoffs, inflation, or financial collapse. But the market has this frustrating habit of recovering when people still feel scared. And historically, some of the best market days happen very close to the worst ones. Which means if someone panic sells during a crash and waits for the perfect time to get back in, they often miss the recovery entirely. Imagine somebody who spent 10 years investing consistently, then sells everything after a major downturn because they can't emotionally handle the losses anymore. The pain stops temporarily. Their account is no longer falling every day. Emotionally, it feels like relief. Financially, though, they may have just locked in years of damage. because compounding only works if time stays uninterrupted. It's kind of like planting a tree and digging it up every few months to check if it's growing. The constant interruption becomes the problem. And honestly, this doesn't just apply to panic selling. Small financial behaviors quietly erode wealth all the time. High investment fees that seem close enough, constantly switching strategies every 6 months, chasing trending investments after prices already exploded, pulling money out of investments for lifestyle upgrades, stopping contributions whenever the economy feels uncertain. Individually, none of these decisions seem catastrophic. But over decades, tiny leaks sink giant ships. A 1% difference in fees or returns might not sound life-changing today, but over 30 or 40 years, that gap can become hundreds of thousands of dollars, sometimes more. That's the brutal reality of compounding. It magnifies both good behavior and bad behavior quietly in the background while people barely notice. And unfortunately, human psychology is almost perfectly designed to sabotage long-term investing. Our brains crave certainty, immediate rewards, social proof. When everybody around us is making money on some hot stock or crypto trend, dopamine kicks in, and suddenly patience feels boring. Staying disciplined feels slow. Conservative investing feels like you're falling behind. But then fear takes over just as quickly when prices collapse. Humans naturally follow crowds because historically, following the group helped us survive. In markets, though, herd mentality can become financially destructive. People buy because others are buying. People panic because others are panicking. Very few people are making calm decisions at emotional extremes. That's why successful long-term investing often feels uncomfortable. Usually the right financial decisions emotionally feel wrong in the moment. Continuing to invest during uncertainty feels scary. Holding quality investments during volatility feels stressful. Ignoring financial noise while everyone else reacts feels unnatural. But wealthy long-term investors understand something most people eventually learn the hard way. Wealth is often built through consistency more than brilliance. A lot of millionaire investors are honestly pretty boring. They are not constantly predicting crashes. They are not rebuilding their portfolio every week. They are not emotionally reacting to every headline notification. They focus on staying invested, managing risk, avoiding catastrophic mistakes, keeping costs low, thinking in decades instead of days. And most importantly, they protect the compounding process at all costs. Because eventually, investing becomes less about finding the next big winner and more about avoiding the behaviors that quietly destroy wealth before it has time to grow. One of the hardest parts about investing is that financial damage usually happens invisibly at first. For example, when a portfolio drops 50%, most people emotionally think, okay, I just need the market to go back up 50% and I'm even again. But that's not actually how the math works. If you lose half your money, you need a 100% gain just to recover back to where you started. Loss of 50% required gain of 100% to recover. That's why emotional selling during downturns becomes so dangerous. Losses hurt exponentially more than people realize. And then there's opportunity cost, which is basically the money you could have earned if your investments had stayed growing. Think of compounding like a snowball rolling downhill. At first it grows slowly, almost invisibly, but eventually momentum becomes massive. Every time someone panic sells, stops investing for years, or constantly jumps in and out of the market, it's like picking that snowball up and dragging it back uphill again. The problem is that markets often recover before emotions recover. Historically, missing just a handful of the market's strongest recovery days can dramatically reduce long-term returns because those big rebound days tend to happen during periods of maximum fear and volatility. Meanwhile, inflation quietly works against idle cash in the background. So even when people think they're playing it safe by never investing, their purchasing power slowly erodes year after year. That's why consistency matters more than perfect timing. Volatility itself is normal. What destroys wealth is when volatility changes investor behavior. And this is why the conversation matters so much beyond just stocks, charts, or portfolio balances. Because investing mistakes don't only affect numbers on a screen, they affect future life options. The difference between someone who protects compounding for 30 years versus someone who constantly interrupts it can literally become the difference between retiring comfortably or working far longer than they planned. Between having flexibility in your career or feeling trapped by financial pressure. Between helping your family later in life or struggling just to maintain stability yourself. A lot of people think wealth is built through one huge financial breakthrough. In reality, long-term wealth is often the result of avoiding a few major mistakes over and over again. Sometimes not panicking during one bad market period can end up being more valuable than finding the perfect investment. Because lost years are incredibly expensive financially. If somebody stops investing for 5 or 6 years after a crash because they're emotionally exhausted or afraid to get hurt again, they're not only losing time in the market, they're losing years of future compounding that can never fully be recovered. And the emotional consequences matter too. Financial stress changes how people live. It affects relationships, sleep, confidence, and long-term decision-making. When money constantly feels unstable, life feels unstable too. That's why protecting the compounding process is one of the most important financial skills a person can develop. Not because it guarantees perfection, but because preserving long-term growth gives you something incredibly valuable over time: options. The way you avoid this silent, wealth-destroying mistake isn't really about having more discipline in the moment. It's about building systems that protect you from needing discipline in the first place. For example, one of the simplest but most powerful habits is automation. When your investing happens automatically every month, you're no longer making a decision based on emotion. You're just following a structure you already agreed with yourself on during a calm period of life. That removes a huge amount of behavioral risk. Another important shift is reducing how often you check your portfolio. Because every time you open that app during volatility, you're re-exposing yourself to emotional reactions you don't actually need. Long-term investing doesn't require daily confirmation. It also helps to predefine your rules before emotions show up. Things like, I am not changing my strategy during market downturns, or I will continue contributions regardless of headlines. When those rules exist in advance, you're less likely to negotiate with fear later. And then there's diversification, which isn't just a financial tool, it's a psychological one. It reduces the emotional impact of any single investment moving sharply, which helps you stay steady during volatility. Keeping a proper emergency fund also plays a big role here, because when you know your short-term safety is covered, you're far less likely to panic sell long-term investments out of fear. Ultimately, the goal is to remove as many emotional decision points as possible and replace them with a simple, repeatable system that continues working even when you don't feel confident. Beyond panic selling, there are a few other patterns that quietly destroy wealth over time, and most investors don't even recognize them as mistakes while they're happening. One of the biggest is chasing hype. It usually starts when something is already trending: stocks, crypto, hot sectors. People see others posting gains online and feel like they're missing out. Psychologically, it's not really about the asset itself. It's about not wanting to feel left behind. So they buy after most of the move has already happened, often right when risk is highest. Then there's constant strategy switching. Someone reads a new investing approach, gets excited, abandons their old plan, and starts over. Then a few months later, they find something else. It feels productive in the moment, but in reality, it breaks consistency, which is the foundation of compounding. Over-leveraging is another silent issue. Borrowing to invest or taking on too much risk often comes from overconfidence during good markets. But when volatility returns, leverage turns normal fluctuations into emotionally overwhelming losses, forcing bad decisions. Even something as simple as ignoring fees can matter more than people think. A small percentage difference doesn't feel meaningful year to year, but over decades, it quietly reduces total growth. And then there's lifestyle inflation, where rising income leads to rising spending instead of investing. It feels natural because life improves gradually, but it reduces the amount of capital working for the future. Social media amplifies all of this. People compare portfolios, highlight wins, and rarely show losses, which distorts expectations and encourages emotional behavior. Most of these mistakes come from the same root cause: reacting to short-term emotion instead of long-term strategy. At this point, I'm genuinely curious how many people watching this have gone through something similar. Have you ever looked at your portfolio during a downturn and felt that sudden urge to just get out completely? Or maybe you sold something during a panic, felt relief for a day or two, and then watched it recover later? Or on the other side, have you ever chased something because everyone online made it look easy, only to realize you were late to the move? Most investors don't talk about these moments openly, but they're far more common than people think. And honestly, they're not signs of being bad with money. They're just signs of being human in a system that constantly triggers fear and excitement. If anything, the goal here isn't perfection, it's awareness. So I'd like to hear your experience. What's one investing mistake that actually taught you something important about your own behavior? Or what's a financial habit you're currently trying to improve, even if it's small? Because when people share these stories honestly, you start to realize nobody is completely immune to emotional investing. The difference is just whether you learn from it and adjust your system over time. And sometimes, learning from other people's mistakes is just as valuable as learning from your own. If there's one idea to take away from all of this, it's that wealth usually isn't destroyed in a dramatic moment. It's not one bad trade or one market crash that defines someone's financial future. It's the quiet decisions made under emotion: selling when fear feels overwhelming, buying when excitement feels contagious, stopping when things get uncomfortable, restarting when confidence comes back. over and over again. And each individual decision feels small at the time, reasonable even. But over years, those moments stack up in the wrong direction, and suddenly the gap between what someone could have built and what they actually built becomes enormous. That's why protecting compounding matters so much. Because once you understand how wealth actually grows, you realize it's less about prediction and more about preservation. It's about staying in the game long enough for time to do its job. Most investors don't fail because they lack intelligence or opportunity. They struggle because emotional reactions keep interrupting a process that was designed to reward patience. And the irony is that discipline often doesn't feel rewarding in the short term. It can feel slow, uneventful, sometimes even uncomfortable when everyone else seems to be doing something more exciting. But over long periods of time, discipline is what separates outcomes. The people who build real wealth are usually not the ones trying to outsmart the market every year. They're the ones who simply stay consistent long enough for compounding to become undeniable. And in the end, that's what this really comes down to. Not being perfect, just not breaking the system that quietly builds everything in the background. If this idea about emotional investing and silent wealth destruction resonated with you, the next step is pretty simple. Keep learning how to avoid these patterns before they cost you real money. Because the truth is, just like investing itself, financial education also compounds. The more you understand these behaviors early, the fewer expensive mistakes you end up making later. And over time, that gap becomes very real in your results. If you want to go deeper, I'd recommend watching the next video where we break down how long-term investors actually structure their portfolios to stay steady during volatility, even when everything around them feels uncertain. It connects directly with what we talked about here. And if you're serious about building long-term wealth, staying consistent with this kind of learning matters more than any single investment decision you'll make. So consider subscribing if you want more practical, grounded breakdowns like this. Not hype, not noise, just real financial behavior and how it actually plays out over time. Because in the end, the people who win financially aren't the ones who react the fastest. They're the ones who keep learning and stay consistent long enough for it all to add up.